Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Tucker. On this segment, what I would like to do here is to take a look at a couple of reports that we just published. But let's just take a brief look at gold trading last at 1684.70, down about 1380. Excuse me. Silver is at 25.24. Let me bring up the trade station robot here. You can see the metals down slightly. Silver is trading right around the average price of 25.21 and a half, 25.26 approximately. So the thing I want to do here is I want to take a look at a couple of things. Number one, we are looking to get long at the gold market on a close above 1686. We are long. We recommend to get long on a close above 1686. We are in an area where the AI is identifying a high probability that we're going to see some kind of a reversion unfolding from these levels. The levels in blue on the pivot points highlights basically the probability, the mathematical probability that we're looking at about a 90% probability that if we get a signal triggered and the momentum unfolds, the next target activated would be 1696. The silver is trading roughly around the average. So it is early morning, and markets are digesting pretty much all this news about the stimulus, 1.9 trillion. Looks like it's going to be signed tomorrow. So let's take a look at the latest podcast that we published here at the Equity Management Academy over the weekend. Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Weekend Podcast for March 7th, 2021. The dichotomy between paper and physical precious metals markets. We are still dealing with the dichotomy between the paper and physical precious metals. There is a shortage of silver and a tightening physical gold market, yet the price goes down. The market is reacting to the fact that in early January, the 10-year note was at less than 1%. It has jumped to 1.60%. The printing of massive amounts of money will in all likelihood lead to rising interest rates and inflation, which is extremely bullish for gold. If you're looking for portfolio ideas like this one, please look into the mean reversion trading. Get the exclusive access to our model portfolio in Seeking Alpha. Shortages of gold and silver. We are still dealing with the dichotomy between the paper and physical precious metals markets. There is a shortage of silver and a tightening physical gold market, yet the paper price goes down. We have never had such a bullish fundamental situation with the pandemic, debt levels, unemployment levels, and all the other consequences of COVID-19 and the lockdown on the economy. The printing of massive amounts of money will in all likelihood lead to rising interest rates and inflation. The 10-year note is up 1.578, a new high. The yield on the 10-year note is near 160. The market is reacting to the fact that in early January, the 10-year note was less than 1%. It has jumped to 1.60%, which means that interest rates have gone up. Most contemporary wisdom will interpret a rise in interest rates as bearish for precious metals, since it may indicate a stronger economy. The 10-year note is beginning to validate that current monetary policies are going to be highly inflationary. The anomaly is that the rise in short-term interest rates is causing pressure in almost every sector, from stocks to gold. Stocks are reacting to the rise in interest rates. However, we believe that's a misperception. If we use the 1970s as a point of reference, the U.S. went off the gold standard and inflation began as the U.S. dollar was devalued against gold and other assets. Interest rates rose to 14% and gold shot up. A dime made out of silver in 1965, which was 99 or 90% silver, can buy a gallon of gas today. The U.S. dollar is a paper fiat currency. It is not backed by any natural resource that will maintain its intrinsic value. It's backed by only the faith and trust in the U.S. government. As the dollar decreases in value, you begin to see what is real money by what retains value. Loan delinquencies. We are beginning to see sharp increases in defaults on various types of loans. Rob Kint, author of Drop Shadow and founder of GoldSilverPros.com, recently highlighted raising delinquencies in various sectors, including the auto sector, bank cards, and mortgages. Most are experiencing increases of several 100% increases in delinquencies. The trend, Kent argued, is that eventually you are going to see mortgages get more in arrears. First are the unsecured personal loans, then the cars, then it will hit credit cards, and finally mortgages. People want their shelter and their credit cards to allow them to continue to live. As delinquencies increase, such loans will be harder to get, which will ripple across the economy. Banks' liquidity ratios get strained as delinquencies rise. There will be a cascade of defaults, and then banks will stop lending as much, especially to subprime borrowers. They will lose out first. But then the other credit ratings will be hit with more difficulty in securing loans. Texas and Mississippi are removing their COVID-19 restrictions, which is getting a lot of criticism. However, Kent argued, if their leaders seeing this happening, they may be realizing that this is a significant problem is on the horizon. Unless the economy reopens, the whole economy could be dire trouble through cascading defaults that could trigger a depression. The Fed can print all the money they want, but if banks aren't lending, then the economy will crash. Each round of quantitative easing is also less effective than the past one. The Fed can't lower rates because we are already almost at zero. Usually you need about 5% interest rates to jumpstart an economy, but we don't have that now. We may be near the end of a fiat currency system, with it about to crash. Banks are beginning to raise mortgage interest rates. So the age of ultra low rates is almost at the end. The 30-year mortgage rate is about 3% now. U.S. home loan applications fell to a 9-month low. So lending is going down and things would only get worse. Banks are raising mortgage rates because of the increasing number of delinquencies in other areas. Bond rates are also rising. Rising rates will increase mortgage solvency for adjustable rate holders. That further decreases the liquidity of banks, which also decreases their ability to lend. Therefore, the housing market will be stressed and prices may fall. All these factors stress individual borrowers and banks. Less money is coming into the system. The whole economy is starting to seize up, which will trigger a rise in precious metals prices as a safe haven. Kent argues, as we have highlighted in early articles on Seeking Alpha, that there are already shortages in silver and gold, which will only worsen with time. He, like us, also highlighted the divergence between the paper and physical markets. All of these factors suggest strongly that gold and silver prices will rise significantly. We strongly recommend that you go long gold and silver. Short-term, the rising 10-year note rate is making the dollar stronger, which is affecting the price of gold and silver negatively. If you look at the COMEX report for the last delivery date, the open interest of gold was about 317,000 contracts. There were 5,000 contracts to stand delivery. The open interest went up from 317,000 to 367,000 overnight. As Kent argued, if there were only 5,000 contracts waiting for delivery, why were 50,000 contracts sold? That is a 10-to-1 ratio of paper gold that does not exist. The paper shorts have drove the price of gold down. There has never been as great an interest in taking delivery via futures contracts in gold and silver, because it's almost impossible to buy physical gold and silver. Short sellers have reduced the risk of their position in silver from about 40 billion to far, far less. Silver and up to about 30, but appears to have put in a short-term top. The variable change in price momentum indicator identified that level as an area where supply would come into the market. Now, for silver, we are at an extreme below the weekly mean of 2711. We have a bearish trend momentum which activates the extreme levels below the mean of 25.75 and 24.79 for this week. If you were short, this is the area to take profits. Now we will see if there is more selling pressure or if the VCPMI is right and we will find buyers coming in at these levels. A close above 25.61 or 25.75 would activate a weekly buy trigger. This is how the VCPMI identifies the entry points for trades that are high probability. The daily and weekly triggers are aligned, which is one of the strongest signals to buy. The price and the momentum are in harmony. Gold is trading above the weekly buy signal of 1694. We have an ongoing back and forth between the buy triggers and hitting the VCPMI targets. We are seeing $20 and $30 swings as if they were just a few dollars in the old days before volatility increased. We may be seeing a reversion all the way up to 1780. 1694 is the weekly buy trigger. We are neutral now, waiting to see if gold comes down and activates another buy trigger. If activated, the target above will be 1715. Based on the trend lines, if we close above 1701, we will confirm that we are at a bottom. So we have several indicators showing that we are near a seasonal bottom.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.
I wanted to share this podcast as we move into this week. On the right of the chart, you see basically the numbers that we're looking at for this week. And I want to share with you the reports that I published in Seeking Alpha as a courtesy to give you an idea how we distribute the intelligence of the VCPMI. You can find this at Seeking Alpha mean reversion trading in the marketplace section of Seeking Alpha. This is a weekly report for March 5th, 2021. This should be 2021. I apologize for that. Summary: the weekly trend momentum is bearish as we come into this week. And we use basically the first filter of the VCPMI basically to identify the trend of the market. We use the 9-day moving average, the 9-week moving average, the 9-month moving average, and we go on, so on and so forth, in using all the other segments in terms of time frames. What we're looking at is the time frame for next week, and we've identified the weekly trend momentum is bearish. We'll get into the more individual prices of the algorithm and the easy language, pretty much, which is written on. The weekly VCPMI of 1713 is bearish. So as we come into this week, the weekly average is 1713. Because we close below 1713, we are coming in with a bearish weekly trend momentum. The moving average identifies the price momentum. The weekly VCPMI, daily, monthly, annually, cyclically, identifies the average price. Once we identify the average price, then we can extrapolate the levels above or below. If you look at the right of the chart, obviously, market was trading at 1709 when this was published, when this picture was taken, which was at about 6:15 p.m. on Sunday evening. Market was up to 1709.90. And we didn't quite get to the average on the weekly, but we did get above the average daily, which you see was 1696 for today. So on this report, I basically take a look at the weekly report at the numbers that you see on the right. And we get into a little more in detail in identifying the different filters of the algorithm. The first filter is the 9-day moving average that basically I am pointing out to you. And with the gold market pretty much trading below that average price, we're looking at a bearish trend momentum here. We got something going on here. Bear with me 1 second. Let me take a look at some things here. We got a fast market on silver here. What I wanted to point out to you were the buy levels here that we were looking at. But we've entered a fast market condition. So let me focus back on the market here because we got some live positions here that we're trading. You can see the signal being activated again from the buy one level daily. And what you see on the chart basically is the relationship of the daily signals for day traders, for example, or if you're a trader period where you use all of the different time frames and you customize your strategy, obviously, between all the different trends, as we are recommending to, take a core position in precious metals here, particularly in the silver market. And what I'm doing here, ladies and gentlemen, I'm showing you how I use pivot points, which is part of the algorithm that identifies the probability factor in conjunction with moving averages, in conjunction with wave counts, WDGAN formulas, and primarily vortex mathematics. And the algorithm activates all of these individual indicators into one that you see here in a very simplistic fashion by highlighting the area in blue. And it's telling you that this pivot point at 1686, ordinarily, if you take a look at pivot points, and there are many different pivot points, we have our own proprietary formula that we use that matches sometimes some of the most standard ones. But the pivot points that we have, they tell you a little more than, just resistance or support. The level in blue activates and makes you aware that you are in a high probability mathematically level of the extreme below the average price of the supply and demand for that day. And it tells you, the algorithm tells you, if it closes above 1686, it activates a buy trigger. And that's what we pretty much are looking at in terms of the gold market. The silver market is a little faster, it seems. $25.34. It has gone through the daily average price, and when it does, and this is the first filter. Oh, I'm sorry, the second filter that we use, which is the VCPMI, which stands for the variable changing price momentum indicator. It activates the trend momentum. Above is bullish, below is bearish. It's in green. It's 50-50 standard deviation. So what it does is it prepares you for the next target, which, by the fact that the market is trading above the average price, is 25.59. It went long on the close of 25.2850. The protective level is a close below 25.22. Automatically, it creates the structure for the trade. And the market will do what it's going to do. If you want to take the risk of trading standard deviation, you are a self-directed individual. I personally want to trade the highest probability trades, and that's when the market comes down. If I'm buying, obviously, as close to the extreme below the average price or the mean. And in this case, 24.93 was the level coming into today that was highlighted, activated by the market trading below the average price. But now it's negating that bearishness. And this is what we don't want to, as a trader, be chopped up into the standard deviation level that clearly the algorithm identifies, and the market confirms it. There's a very high synergy between the price and the momentum indicators that we have. And the algorithm tells you, just here, you're looking at the average price, 50-50 standard deviation. The sell 1 level is 50.90. The sell 2 level is 50.95. Standard deviation relative to the implied volatility of the mean, of the average price. So this tells you that when you get up here, you're looking at a probability that you're going to find sellers, which is what I continue to reiterate, in terms of the application of the VCPMI, that the red area is a mathematical area where the VCPMI tells you that it's a high probability to find supply. It's an area of distribution of supply. Sellers. And so we got up to 25.88 on the 7th at about 6 p.m. Reverted a short trigger, met the target below, activated another short trigger from sell 1 into the average price of the mean that you see. And that's when you go neutral. If you were long, you get out here. If you want to take the risk of shorting this explosive market potentially any day, then, you take that risk. Or if you want to match it, or if you want to hedge your inventory, depending upon your personal profile, you can use this as a GPS to guide your trading, to customize your inventory, and to manage the risk accordingly. So we came down, the signal was validated, and now we're activating a bullish trend momentum, and the target of 25.59 has been activated. Let me share with you the report. Take a look here for a minute. Bear with me. We publish reports in the Associated Press through Seeking Alpha every week, and in those these reports are shared with our subscribers in our trading room, the Discord trading room, and let's take a look at the gold market here. The summary, the weekly trend momentum is bearish. The weekly VCPMI of 1713 is bearish as we come into this week. And this tells us that if it closes above 1713 stop on a stop basis, it negates this bearishness neutral. So the first level on the short side, if you are short, you want to put your stop at 1713 and you take your profits at 1668 to 1639 if the market comes down to those levels. So we use the extreme levels above or below the mean. And this report gives you a little more in detail the direction basically of the algorithm. This is the pretty much the easy language content. And what we did is we reversed engineered the algorithms so that we can use it for ourselves on a self-directed basis, or we can use it for subscribers that are interested in following the artificial intelligence of the algorithm. And as I said, the first filter that you're looking at is the trend momentum, which is at 1803. It's bearish coming into this week. The market closed at 1699 on Friday, and the market closing below the 9-day moving average of 1803 is confirmation that the weekly trend momentum is bearish. But it also gives you an alternate count that if we close above the 9-day moving average, it would negate this weekly bearish short-term trend to neutral. So it gives you two signals. It tells you what the trend is, at what price, and what the market will do if it closes above that. The first time it closes above it, it goes neutral. The second time, it activates the trigger point. Now, the second filter that we use is the weekly price momentum here that you see at 1713. With the market closing below the weekly price momentum indicator of 1713, is confirmation that the price momentum coming into this week is bearish. But it also tells you that a close above 1713 would trigger weekly stops anytime during the week. If it closes above 1713, it would negate this bearishness to neutral. And a second close above it would activate the trigger point. So this identifies the average price, the variable changing price momentum indicator for the rest of this week. Now, because the trend momentum is bearish, it activates or pretty much identifies the levels, the buying levels below the extreme of that average. And in this case, it's 1668. It's the buy one level. The buy two level is 1639. So it tells you if the market comes down to 1668, it completes the pattern. And if it closes above it, that activates the trigger point. When you enter, if activated, then simply you use the level below as your protective level. And this tells you clearly that look to take profits on shorts into corrections at the buy one and the buy two level of 1668 to 1639 and go long on a weekly reversal stop. It's pretty clear. If it does activate, then use initially the 1639 level as your protective level anytime during the week. Now, on the other hand is, if you're long, if it activates the 1713 buy trigger, automatically it tells you that look to take profits on longs as we reach the sell 1 and sell 2 levels of 1743 to 1787 as we come into this week. Let's take a look at the silver market. Mind you that what I'm doing here is I'm sharing with you the AI, the intelligence, basically, that the VCPMI is identifying for us. Not necessarily bringing in any of this fundamental rhetoric that we have going with the stimulus and the shortage of silver, the short squeeze. I mean, that's pretty much already factored into whatever the market is doing right now. And what we're doing is looking at the probability models that we use that identifies the price and the momentum of the market. And in looking at silver for this week, the weekly trend momentum of 2618 is bearish coming into this week. This is again the first filter. It identifies the the trend momentum, and it's bearish coming into this week. So we can expect that the market was going to be lower. Also, the weekly variable changing price momentum indicator of 2577 is bearish. So it has activated the buy one levels below on the weekly of 2437 to 2344. The first filter identifies the average price, and it's 2618. The future, the market closing at 2529. It closed below the 9-day moving average of 2618, and it's confirmation that the weekly trend momentum is bearish coming into this week. But it also gives you an alternate count that if it closes above 2618, that it would negate this bearishness to neutral. The second filter, the VCPMI, is at 2577, and it's bearish. With the market closing below the VC weekly price momentum indicator of 2577, it confirms that the price momentum is bearish, but it also gives you an alternate count that if it closes above 2577, it negates this bearishness, and a second close above it activates a bullish trend momentum. Because we are bearish, it identifies automatically, as I said, the buy one level of the extreme below the mean of 2437, which is a 50-90% standard deviation relative to the implied volatility to the mean of 2577. The B2 level is a 2-to-1 factor of the relative implied volatility to the mean, 50-95% probability factor. The lower it goes from here, the higher the probability that we're going to get reversions rejections at these lower prices. The bearishness that we have coming into this week tells us that look to take profits on short into corrections at these levels of 24.37 if we see it, and start to get long all the way through down to 23.44, and then use that 23.44 as your protective level. So we are finding ourselves today, obviously, trading above the average price and on the daily, above the average price on the daily, and below the weekly average price. So that's a kind of a mixed signal that we have in silver. And so from a conservative point of view, there's no trades for day trading. From an aggressive point of view, if you are an aggressive trader, this has activated the momentum to take us up to that sell 125.59 and possibly the average of 25.77. Your protective level would be 25.22. Now, we've been talking about the futures contracts here, obviously in gold and silver, but underneath the futures contract, you have thousands of derivatives, stock shares, ETFs that you can trade in following, in using this momentum indicator to position yourself, accordingly. We've been taking a look at the GBTC. We recommended last week for us, for our traders here in the private trading room and Discord, to go long GBTC. And it's turning out to be a good trade. Market has resumed the uptrend, so to speak. And the weekly target is 46.40. We have completed the first sell one daily level of 14.99. And we seem to be moving up into the average weekly price that is in between the daily sell one and sell two level. So if you bought long here, this is a great tradable instrument. Manage your position accordingly and lock in some profits up here if the targets are activated. The E-mini S&P is trading above the daily average and the weekly average price. It activated a buy trigger from the 37.20 levels last week, and it tested these levels 4 times, as you can see here, using the 15-minute bar before it really reverted right back up above the average daily and weekly. And we're looking at the market coming back down, testing those averages, and reverting right back up above. And we're looking at 38.84 to 39.28 now to be the targets. The weekly targets, the sell one level is 39.28. There is still an anomaly, a dichotomy in terms of the fundamental picture of the gold market in relation to the shortages that seem to exist. I was trying to get physical over the weekend, and there's no 100-ounce bars, there's no small denominated coins available. There's a fair amount of 1,000 ounce bars that seem to be holding some a normal premium. And I think as we move into this market here more and more, and we get more people to be aware of this anomaly in the paper market in relation to the physical market, we're going to start seeing definitely some activity in the market. There, in terms of the premiums in the physical market, I believe they're charging pretty high premiums. So, why is the price coming down? Is pretty much the anomaly that we have, particularly for the silver market. And I've looked at the Commitment of Traders report, basically, that gives us a very, very good picture, a clear picture of who's, who are the players in the market. And we pointed out, in just before the last delivery date, we had about 317,000 open interest, and the day of delivery, there were about 5,000 contracts to take delivery, and 50,000 contracts were shorted. And so I think what you want to understand is that, first of all, that is a 10-to-1 ratio of selling supply that doesn't exist, supposedly for future production. It's the numbers are completely unrealistic in terms of the production ability to be able to sell that that much physical. And what happens is they know that everybody that trades in futures contracts use straight stops. And particularly if we go back to the Wall Street Reddit, rate, so to speak, that forecasted silver to be at 1,000, going to 1,000. The market opened up on Monday, made a high of 30.35, and it reverted right back down to test the average price. And now we're testing the extreme below the average price. We made a low of 24.8450 as of last week, as of Friday. And this is on the face of this tremendous bullish news that is all over the internet, and that everybody's talking about and everybody's commenting about, and short squeeze, and $200 gold, a $200 silver, and on and on and on and on. They sound like a broken record player already. And the market is not reacting to that analysis because it discounted up here that this was very weak buying that we come into the market. The Reddit crowd attracted the retail end of the business that doesn't understand that you can't chase markets like that. The young traders of Wall Street silver, this was the probably first lesson to many, many traders that followed the herd. You don't follow the herd when you're trading in these markets. You wind up going to the slaughterhouse. So what we use is a perspective tool that identifies the price relationship to the momentum of the market, because what we have found is that the price is the consequence of the momentum of the market, which is the energy prior to the price accomplishing a target. So where are we now and where are we going now? Well, if you take a look at obviously where we are, we're trading above the average prices now. We've reverted right back down from a low of 24.84 as of last week. So that is going to be a very important low. Also, the low that was made back on January, just before the raid, is going to be an important low, and that is into that 24.04 level. What we're looking at in terms of the market here is that this energy pattern here skewed the underlying momentum of the market that we were trading prior to this, and it has skewed actually bringing the market seasonal top sooner than what should have been. And it has brought in everything with it in terms of making the top shorter term, and also bringing in, adjusting, recalibrating the prospective levels accordingly. So that means that basically this correction that we see here, it potentially is going to be an inverted bottom, because the expectations was that the top of the seasonal pattern was going to be taking place sometime around the middle of March. So we have to recalibrate the energy patterns that we use, the momentum indicator that we use, and obviously the market is saying that the rally that we saw completed the upper pattern, the upper distribution area of supply, and found basically the supply that it needed to revert back down to test the mean and then some. And obviously when the market goes below the extreme below the mean, then you're looking at the B1, B2 level, and then you begin to connect the daily with the weekly, with a monthly, with a yearly price. You begin to connect the short-term trends with the long-term projections in the market. And the 24.94 was a monthly buy one level that was activated last week. And we're looking at the market trading above the first level of the buy one monthly level of 24.94. The area of accumulation of supply recommended by the VCPMI is between 24.94 to 23.28. The VCPMI recommends that even if the market comes down below 24.94, you do not go short in this area. You want to be looking for reversions, basically, to unfold from these levels. And that's what we're beginning to see as we start the week. So just to reiterate this interpretation of the VCPMI, is that we have come down in gold and silver into areas that are indicating high probability area to revert back up. If we're looking at the gold market here, we're testing that 1678, which is the 9-year moving average. And right below there, you're looking at 1673, which is the buy 1 monthly average. So we are activating a 9-year trigger from the 9-year average of 1678, and right below it, we have the monthly buy 1 level of 1673. So this is pretty close to what we identify to be is a harmonic relationship. And what this tells us is that there is a very high probability that once we complete this targets, the market will revert from here. So we've come down pretty much from the sell 1 level of 1834, which was the monthly trigger point that was activated on February the 11th by closing below it, meeting the target of 1775 and coming down here to the yearly and monthly levels. On the left of the chart, you see the 1810 number is the yearly average, the 360-day average. So I think to summarize this, we've come down to extreme levels below the average price for gold and silver that indicate a very high probability that if we're going to see a move up from here, we should be able to see it in the very near future if it's going to revert from here. Do not go short here. If it doesn't activate the signal, do not go short. Wait for the market to complete whatever the energy pattern is on that short end of the market. And once the market reverts from there and it closes above the trigger points that we indicate, that's when you execute your trades. I hope today we were able to really kind of dig into the structure, what's behind VCPMI, and I hope that this was very helpful to you. I continue to thank you for the opportunity to share this with you, and I look forward until next time, my friends. Be well, take care. Have a great trading week.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Patrick, I know from our previous discussions you have a somewhat different background than many typical